I'm setting the scene here by just laying out what ASX-listed companies come under in terms of corporate governance, and I've sort of aligned it with what super funds come under so we can see what we cover, what they cover. And the slide, I guess there's some areas where I was going to pull out a little bit more detail, which is the ones marked red on the slide, because that's where I see the key differences as occurring. So I think the first key difference is that with the ASX 8 principles, and I think there's 29 recommendations, they're not mandated. They are, if not, why not? So they're encouraged through a process of requiring all ASX-listed companies to report against them every year, either in their annual report or on a website. The difference between that and the superannuation area is that our corporate governance standards are mandated. They're mandated through our prudential standards. And the reason that it is argued why we're mandated for corporate governance is because being an APRA-regulated entity, it's considered that the intensity of our promise is greater than that for listed companies, and that's because contributions are mandated into super, they get tax concessionals, and they're necessary for retirement income. So there's a really key difference there about the fact that ASX listed are under if not, why not, encouraged, and we're mandated. And as part of that mandating, there is a current discussion around whether that's actually forced super boards into a quasi-management role. And Mercer's actually had an interesting statistic in their second submission to the FS inquiry where they'd counted 44 areas under the prudential standards where boards have to sign off, which gives rise to this argument that boards are being pulled down into a quasi-management role. So I've set out the 8 principles. I've got all 29 recommendations covered. I haven't got 29 listed because some of them are sort of like things like evaluations of boards, evaluations of management. I've just combined into evaluate performance. So, but everything is down. That's basically is an issue. It's just sometimes I've aggregated them up. So if we make a start, under management and oversight, which is the #1 principle of the ASX things, it's about clarity of board roles, doing pre-checks on directors, which is much like our fit and proper checks, having written agreements of the roles, having a clear company secretary role, evaluating performance. All those areas are really quite clearly covered in our governance standards and our fit and proper standards, and there's not a lot of difference between them. They're actually pretty similar. One that is different is that ASX listed are required to have a diversity, which is particularly focused on gender at this stage policy. They have to have a policy. They have to have measurable objectives. They have to report against those objectives. They are encouraged to do gender equity pay audits. And although the focus on that policy for now is very clearly on gender, they do note that diversity is a lot more than gender. Diversity is age, race, style, a whole lot of different things, but they're initially focusing on gender. And the reason why they have that policy clearly there is because they feel there is sufficient information to show that boards that are diverse have better performance longer term, and therefore they brought it into one of their key recommendations. Just as an interesting aside, there was a large bank that actually thought they were doing a very good job a number of years ago about instigating gender pay audits, where they went through and they did an audit of all their employees and they rebalanced everyone up because there was a difference, and they felt they'd done an excellent job in that regard, and they had. When they went back 3 years later to look at how they were tracking against it, they realised that although the base pay they had got to an equitable state, where it was always being lost out was on things like bonuses and promotions. So it came to the point that when you sort of set up a base pay, it's a lot easier to set up gender pay equity, but once that subjective element comes back into play, that was when women were obviously losing out. So I thought that was an interesting thing that they had discovered doing that work from a number of years. So the second area is structuring the board to add value, and this is the whole point about this is making sure you've got the right chair and the right directors, and from then on the right CEO. So they require nominations committee, they require induction processes, and that's very similar to our governance processes and our fit and proper processes. So some of the areas where it differs is They do require boards to report on a board skill matrix. They do require them to say what are the skills they're seeking from their board members if they don't have already, either have already or are seeking. And they do require information there about directors, about what skills they have. So usually that's addressed through just the biographical details. And the board skills matrix is not about aligning individuals with skills. It's just talking generally about what skills they believe they need to have represented on their board. We don't have that requirement, so there would be plenty of super funds that may do it, but we don't have it as a requirement. The other thing they do is they've got a much clearer requirement about independence. The chair of a board has to be independent, the majority have to be independents, and they have a very clear rule about what independence means. It basically, in really simplistic language, it means that they can't have had a connection, an important connection, material connection with the company for at least 3 years. They can't have been in an executive role or a major service provider, that type of thing. So I think the difference when we talk in the super area about independence is people talk about whether there should be independence or not independence, but it's always unclear to me how they're actually defining independence. They do have a very clear definition that works for them. The other difference is that as part of their induction and ongoing professional development, they have a clearly defined skill that's required as being accounting, understanding financial statements, and they actually specifically list it there. Because since the Centro case in 2011, when there was a misstatement on the financial accounts, it's become very clear in the ASX listed world that everyone has to understand financial statements and everyone has to be able to challenge financial statements, and that's specifically listed there. So we don't have that equivalent thing in our standards. It's interesting because if you've read into the Centro case, it was about misclassifying a current liability with a non-current liability. And to be honest, I think a lot of people who actually understand financial statements and can read balance sheets would not necessarily have even picked up on that issue, unless it was vastly different from a previous year or something like that. You know, for those of you that read financial statements, there's a lot of pages in financial statements, and to sort of pick up, you know, one particular issue, however important that might be, would be great to think that everyone could. But I think the reality is even those that are quite experienced at reading financial statements would not necessarily have picked it up. But regardless, it is a key area of skill, and they do say that whatever your role is on the board, you know, if you're an aged care provider and you're a nurse that sits on that board, if you're the marketing expert or the lawyer, you know, that's sitting on a board, is that you can't rely on, you know, the chartered accountant that sits on the board to read the statements or the chair of the audit committee to sort of make sure that everything looks all right, that everyone sitting on a board has a responsibility to make sure they understand the financial statements and they feel that they've asked all the questions they need to ask on them. Some boards actually, and I know part of the ones I'm on, actually get the external auditor to present to the board rather than just the audit and risk committee to give everyone a chance to ask their questions. On the super side, I would say that there's a couple of areas there where we almost are stronger. So, for instance, we've got a very strong conflicts policy, and APRA is all over that, particularly at the moment, particularly in regards to multiple board roles. They're doing quite a lot of work in that area. We do have a prudent trustee, and like an enhanced trustee role that's come in relatively recently, which is quite a big obligation on trustees. And I think there's another difference between the two areas in this as well. One is that with ASX listed, the directors there have a duty to the entity, to the ongoing entity, and they have a duty to the shareholders as a whole. With Superfun trustees, the duty is clearly under both the SIS Act, fiduciary duty and other duties. The duty is clearly to the members or the beneficiaries, so it's quite a clear duty, primary duty to them first. In fact, this is one of the areas where the FS inquiry has picked up, because they've said, well, we've got 3 entities here who seem to be managing the same pots of money. We've got insurers, we've got super funds, and we've got listed entities, and they all have differences in what those primary duties of those directors are. So super funds, it's clearly to the members. With insurers, they actually have a duty to policyholders over the entity, and with listed entities, they've got a duty to the entity, to the ongoing entity, and to shareholders as a whole. And the FS inquiries actually asked the question, why would we have three types of bodies effectively managing the same pools of money but have clearly differentiated duties? And should everyone have the same duty? And it's interesting because the K review in UK from a number of years ago actually looked at that issue and felt that everyone in that chain should actually have a duty, a fiduciary duty to the beneficiaries, first and foremost, and that was their finding. And as a result of that finding, there was things like a view about having a lot more independent governance committees put into place. So that is an area, I think, where the superannuation area is stronger than the ASX listed area. Another aspect that I found quite interesting about structuring the board to add value in nominations committee is that with APRA, they do encourage boards to document a maximum tenure period. They encourage it. They don't enforce it, but they encourage it. The AXS has a clear statement that they don't believe tenure is in itself an issue, that they want people to think about whether tenure has meant that they've lost their independence or whether they're still adding value, but they don't believe tenure is in itself is an impediment. And it's a view that I actually personally agree with, that black and white rules don't work, but it's interesting that APRA actually do encourage us to document a maximum possible tenure period. Another area is acting ethically and responsibly. So the reason why this is a principle is because, again, the ASX committee have felt that there's enough evidence out there to say that if companies don't have a consciousness of environmental, social and governance factors, that they're going to underperform over time, that there's going to be a loss of value, and that goes against the basic duty of directors. So therefore they put this in as a specific principle, and it gives rise to a couple of recommendations underneath it, such as acting without conflicts, which is very similar to our conflicts policy, and having a code of conduct. And again, that's quite similar, I would say, to our best interest test and our conflicts policy. Areas like financial reporting, there's not a lot of difference in requirements to have an audit committee, that type of thing. Timely and balanced disclosures is obviously something quite specific to ASX listed entities. Respecting the rights of shareholders, this is because one of the duties of company directors is to shareholders as a whole, and therefore you've got to make sure they've got the information and that they can exercise their rights. And I guess the nearest thing that we have is our duty to act in best interests of members. The risk management recommendation is very similar and principles, and we've got that pretty well covered by our risk management policies, our operational risk, financial resources policies and our governance policies, possibly higher in terms of our op risk requirements, generally compared to like a responsible entity where they have net tangible assets requirement. It's generally the rule that larger entities, the op risk requirement would be a heavier financial requirement than the net tangible assets. And finally, under risk, listed companies have a requirement to disclose their exposure to environmental, social and sustainability risks, whereas we don't have a similar thing occurring on the super side. Remuneration, very similar policies. And the final area of difference, which I've listed under super, which is not really in any ASX area, is our investment governance standard. And I actually think this is a really interesting standard because it applies to super funds. It doesn't apply to responsible entities that are also managing a lot of money that super funds actually do invest in for a start. But it's interesting because it picks up things like investment stress testing, liquidity stress testing. And I actually think that there's a lot of good, you know, we can address all these things, whether it's ASX or super, in terms of a ticker box, checker box compliance thing, or we can say, well, what can we really get value out of? And I think there's a lot to be gotten value out of in terms of that governance policy where you do have to stress test your portfolios and stress test liquidity. And even not that I have been able to find out a lot about the Van Eyck failures, to be honest, because it's happened relatively quickly, but it seems that there was one bad investment, 30 million out of 1.3 billion, this is the information that's publicly available, and yet very, very quickly there was people withdrawing their money. And I think in an era of social media as well, it's quite possible that we'll see liquidity runs happening a lot faster and quicker. Nowadays, you can withdraw your money just by pressing a button on your iPhone. So I think things like having stress testing, liquidity stress testing is really important. And given that the FS is looking at how we should be aligning some of these different entities like REs and RSEs, I think that that's one area where REs will increasingly actually come into line under our requirement to have investment governance. So basically, to summarise, I'd say that in terms of the ASX rules, I think they're stronger around things like diversity policy, board skills matrix, and having a clear statement about everyone having to be responsible for understanding of financial statements. I think in the super landscape, we've got strengthened prudent trustee rules. We've got a clear and primary duty to members and beneficiaries. I think we've got stronger conflicts policies, and I think the investment governance is a good policy that we have that others will increasingly probably adopt voluntarily, if not mandated to. I think in terms of challenges to both, I think the key challenge for ASX companies is always short-termism. Short-termism is a challenge to everyone, to be honest. And short-termism is also an issue, I think, for the superannuation area. And maybe not so much that, boards would be trying to make good long-term decisions and things like that, but we are at great threat of short-term policy making. And even the FS has clarified that there is no grand plan, there is no policy, and therefore you do get changes happening like last week with SG that are just changed without any assessment of the implications of changing it. So I think going forward, the FS inquiry has particularly picked up on two aspects, which I think will be interesting. One is this difference in duties that 3 different entities have who are all managing similar pots of money. And the other is alignment of regulation. And again, there might always be a difference between those where an intensity of promise is considered to be much greater. But basically the question has been asked is, why do we have a misalignment between regulation of responsible entities, between responsible superannuation entities, and between listed companies?
We'll commence with the panel session and just want to remind delegates to rate the session and provide feedback via the ASI Hermes app, and also to ask any questions. We've got one question to date, so please ask questions and ask often. So I might ask the first question, open to panel to Jay. In terms of boards adding value, do you want to just give some thoughts as to skills matrices and diversity policies and requirements to have certain skills as a minimum on a board?
Oh, thanks, Paul. Well, in my view, I've listened to what Catherine said, and she's absolutely right, but there's a dimension there, I think, that's almost an intangible, and it's about getting that right mix of people. And in my view, the chair is crucial. The chair is crucial to any board. And that's about, what do I mean by that? I mean a chair's attributes: staying calm, being inclusive, being approachable, having those difficult chats with people when it's required, and yet being tough and decisive when it's required too. Now, in terms of the skills and diversity policy, I think Hester's done a tremendous amount of terrific work in this area. We have a nominations committee that actually retains the right that when we get nominations that we can actually choose in the last instance around the skills and experience. But I think we also got a terrific policy around actually helping people in terms of training and professional development when we perceive there's gaps. So I think it works pretty well. I just wanted to make a general observation too. I've been in some pretty toxic environments, and I think the whole not-for-profit super area is often has that consideration of a longer-term view versus the short-term view out in the corporates. With that, I'll stop. Give someone else a go.
Tracy?
Yes, well, with every board, a board should consider its future strategy in determining what skills are required around the board table. With the representation model, that may be a little more difficult to change in the short term, but in longer term we should always be looking at what is the strategy of the fund, and therefore what skills should we be looking at putting around the table to best add value for the organisation. In terms of specific requirements around the table, and particularly in reference to Catherine's point about the Centro case, and the requirement for people to have a minimum level of accounting knowledge, I don't think everybody needs to be an accountant around the board table. That'd be pretty interesting. But particularly now with the requirements of directors of superannuation funds having the need to be the prudent superannuation trustee, the minimum requirement is that a trustee should understand the business of the fund. It's fundamental, and if they don't understand the business of the fund, then I think the fund and the board has some real issues. In relation to the Centro case, it wasn't so much that people needed to be a technically minded accountant to actually pick up the issue. The issue had actually been discussed previously earlier in the year, and it would have just taken somebody at that last meeting where they signed off on the financial accounts to say, hey, remember we had that problem with that, the short-term, long-term classification? Whatever happened to that issue? How was it resolved? And it's about being able to apply, I suppose, common sense and clear thinking to the business of the organisation rather than really needing to know the technical details of the accounting behind it. Just asking that question maybe would have saved them some pain.
Sure, thanks. Michelle, just to that question as well, if you want to respond, but also do you think that all board members around the table, in your experience or your observation, have equal input to decisions that are made and discussions that are had? And how do you facilitate that?
Yeah, I think what Jay said around the chair and the input of the chair and being able to draw that experience from directors is really important and critical, and each one contributing to the discussion and the decision-making process. And I think you have to ask questions at the board. You know, you can't just rely on staff. You need to do your own research, and you know, you have to read your board papers front, you know, cover to cover, screen to screen, whatever, however you get them. You know, and you need to understand them, and if you don't, you need to ask questions. You know, ultimately you are responsible, but you're responsible on behalf of your members. And so, you know, keeping them in the forefront of your mind in everything that you do, in every decision that you make, and then, you know, determining your own training and your own skill level. Probably most of us here do board assessments, and, you know, I find that really helpful to determine where are the gaps, where are we missing, what areas, you know, I sit in the audit and compliance section of our fund. You know, I don't usually come to this one because this is investment, right? Not my area, but that doesn't mean that as a director I can't just rely on those in the investment committee to take care of those sorts of issues. I need to have an understanding as a director, even though audit and compliance is my strength. So I think it's really important that you ask yourself, what are your skill set, what do you need to know, and go and get the training. There's so much training out there that's available to you, and you know, you can do that. And just ask a question at the board table. I'm sure the CEO won't laugh at you.
Thanks, Michelle. And to that, I guess we all face moral and ethical dilemmas in our lives that we need to deal with, and you know, I guess we sort of refer back to, you know, how we, you know, what our moral standpoint is. Jay, on the boards that you've worked on, both for-profit and not-for-profit, what are the primary moral and ethical issues that you have confronted as a trustee, and how have you dealt with them?
Well, some of the boards in the past haven't had the same concerns around ethics as perhaps I'm finding currently. I think Hester does, or tries very hard to take that longer term view and walk the talk around values. Some of the boards I've been on in the past have taken quite a short term view. Yeah, it's very tricky. If you feel strongly enough about it, you exit with dignity, or even just exit promptly. But yeah, it's a very different mindset.
However, for Superfun trustee boards, there's probably not is there a mechanism to exit swiftly or to create an environment where you're ensuring that every trustee on that board has the same focus and belief set to achieve best outcomes for its members?
Well, you'd hope so, and I think with our representational model, it works very, very well. We of course have diversity of views, but at least they're talked through, and we all seem to get to the same page. And if someone doesn't go with the decision, there's no white anting or anything like that. But this whole ESG overlay, which seeing on a different organisation that I'm involved in where they don't take it serious at all, they just pay lip service, it's quite refreshing to come into the not-for-profit Superfun space and see that it is being taken seriously.
Thanks. Tracy?
Yeah. I suppose in relation to values, being able to have a common set of values across or around a board table is critical, and they need to be discussed and even workshopped, but not just values that are written on a piece of paper. It has to be values in action, and there has to be an agreement, because our values and the values which we subscribe to really underpin our decision making and also underpin our risk tolerances and the risk appetite that we're going to then take through the organisation, and which filters down even through to our investment decision making. So I think alignment of values is probably a crucial aspect around the board table.
Thanks. Michelle?
Well, and so for us, you know, we're local government super, and so at a local government level, there is an expectation that our members expect us to act in an ethical manner, as is expected of them as local government employees, which is how we started. And, you know, obviously we have a very, very strong ESG component, and I think the induction process of directors is really important around that. And I remember when I got onto the board, you know, having a good long discussion around our ESG commitment. In fact, I remember one of our past directors, who I'm sure many of you know, ringing me and checking in with me on my values around ESG before I was appointed, because this is really important to our board and to our fund. And it's very strong for us. I mean, at our last board meeting, you know, we've just added a high carbon screen for our investments, and we think that we are adding value to our investment portfolio, adding value to our members through our strong stance on ESG. And we will, you know, we will argue with companies like, you know, Shell and Woodside and the like around how they're doing business, and that's really important for us, and we take a very strong stance on that. It comes before the board and investment committee, and I think that's really critical, and you know, we weigh everything that we do under that very important banner.
Thanks, Michelle. Are there any questions from the floor?
I've just got a further comment about ESG.
Oh, sorry, okay, Tracy.
Sorry, just a further comment about ESG considerations. I don't think, and particularly on our board, a lot of times there's no question about whether it's worthwhile pursuing that path and to understand our ESG concerns, but our issue is with the implementation, and particularly with in pooled funds. It is difficult to implement those decisions, but at least we're aware of that, and it's a work in progress.
Great, thanks. We do have a question from the floor at the back.
Thank you. We're on? I think we're on. Look, Kathy, thank you very much. I thought the presentation was great. And also thank you, ASI, for tackling the issue. I think it's a very important issue. I want to pick up Jay's point about the chairman being critical. And I'd like to explore what you think the chairman should have, or does have, in terms of his ability to shape the board today. If I compare and contrast, as Kathy did, an ASX board where the chairman can actually determine who comes onto the board versus the current superannuation model. I just want to explore that a little bit more. I thought it would be quite interesting to see what, I guess, influence the chairman can actually have in actually, in your experience, determining the board.
Thanks for that. That's a great question. I'll direct it firstly to Jay.
Well, I think the chair has, and by the way, with respect, his or her, I think that the chair has every opportunity, and it's often about soft power and influence behind the scenes. And so you've got a framework and you have to operate within that framework, whether it's driven by policy in that particular unique organisation. But it's all about the soft power and influence and about getting the right fit and right mix longer term for that organisation. So I just think, again, the chair, it rests fair and square with that role.
Thanks, Jay. Kathy, do you have a thought?
Look, I agree with that about the chair. I think they can influence softly by encouraging people to stand and that sort of thing. But I was probably going to go back on that sort of ethical dilemma type argument that you were talking about before, Paul. Like, I think it's often very, very easy for boards to have the right values and the right ethics when it doesn't come at a cost. And I think that once it comes at a cost, suddenly a whole lot of other reasons come into play. And like, I was involved in credit unions for a long time, and I always remember a story about a credit union in Canada where their biggest client was actually the Catholic Church. And they actually closed down the account because they didn't believe that their stance on homosexuality was consistent with the values of the organisation of the credit union. So I think that when a board has to make a decision about something, about a value that actually fundamentally affects the bottom line, at least in the short term, I think that that's when you have some really interesting discussions about values and ethics. Because I think when an ethic or a value doesn't cost, then everyone has them.
Great, thanks. Tracy?
Yeah, just coming back to the question from the floor, I think the importance and the ability of the board and the chair to shape the board comes back to, I suppose, a soft approach and engagement with the sponsoring bodies. The board needs to be really clear about what skills they're seeking and then engage early in the process with the sponsoring body. So the sponsoring bodies are well aware of what the requirements are, the fit and proper requirements, plus our skills, I suppose, the desired skills that we're looking for at a particular time. And being involved in the process early, communicating with them and engaging with them to encourage the nomination of people that we believe will add value to the board at that stage.
And do you think I think you mentioned earlier about your fund being reviewed. You have a review periodically, possibly every year.
Yeah.
And I think many funds now do that to varying degrees of, I guess, stress testing.
Of the directors, yes.
Yeah. So having done those reviews, and those reviews are then presented to the respective boards, what comes of those reviews?
I think the whole purpose of the reviews for us is not to be a punitive measure. It's more about identifying areas for improvement and also identifying areas where individual directors can look at their own development program and where they want to concentrate their skills development moving forward. And does that actually play out? Yes, it does, yeah. Cool, thanks. Michelle?
I think, and even just taking that question into some of those that are kind of rolling through here, you know, and that internal review of performance, I think that's an opportunity for the chair to actually get involved in that, and if there are potentially poor performing directors or inexperienced or whatever, for that chair to potentially act as a mentor to that director or work it out. And remember, you know, you're responsible for your fit and proper policy and your board charter. So if you've got problems in, you know, diversity or problems in experience or whatever, you know, review your policies, review your charter and get it to what it is that you need to have on your board. You know, you have that control and that ability to make those changes. And, you know, if your chair's there if you appoint your chair for 5 years, well, maybe you need to think about having the same chair for only 2 years so that you can deal with, you know, potentially problem chairs if that's what other directors think. I'm sure none of us think that about our chairs. They're all fantastic. But I also think, you know, some of it can come down to tenure, and there's a question here about maximum tenure for directors. My personal view is 12 years is enough. I probably would even lean towards 10 being enough. I think you need more than 5 because you need consistency, particularly in an investment framework. You know, some of our investments well, all of them, you know, are long-term. And so you need to be able to see some of the strategies and policy decisions that you make. You want to see them through as a director. You want to see them come to fruition and say, oh, isn't it great that we did that all those years ago? So, but, you know, maybe after that, maybe it is time for change, and you do need to bring fresh thinking into your board and into your decision-making, into your discussions, and, you know, see where that goes from there. And by all means, get some more women on. Somebody commented here about how we're all women. Isn't that great? I think it's awesome. And the question here is about, I'm sorry, I'm Paul, I'm taking the questions role here. You know, do they see governance heading in a female-oriented direction? I don't necessarily think so. We have 2 women on our board. I'm audit compliance, and Joanna sits on the investment committee, and she's very, very knowledgeable and skilled in that area. So I don't necessarily think so. I think they just picked women for the governance because that's, I guess, what we women particularly do.
Great. Thanks, Michelle. Jay?
Could I just have a comment about the tenure? I've got a slightly different view. I think, maybe because I'm a slow learner, it takes me a year to even get up to speed sometimes with some of the new boards I go on. But I think someone should be able to stay as long as they're adding value. We all know about David Crawford staying on BHP for 20 years, and now with this new technical term, but some of them are calling it Crapco, the new company that they're setting up and he's going over to. As I said, technical term. So there's probably a deal being done there. But in my view, it's as long as the person is perceived to be adding value. But the tricky question is, once they stop adding value, how do you actually move them? And that's the more of the tricky question around tenure, I often think.
Yeah, and I would agree. I just fundamentally really dislike black and white rules for anything. I think that you can get people who don't add value after 6 months, and you get people who are still adding value after 12 years. So I just don't like black and white rules because I think that they're a bit like black and white, dumb. So, and can I just answer a question here? Sorry, Paul. You probably can't see the questions as easy as
I can. I've just walked across and
so
have a look.
The first question, which is the one that Michelle referred to, it said, 4 excellent women presenting on governance. Investments are still broadly considered to be male-dominated. Do the panellists observe governance heading in a female-orientated direction? Can I just say that as an actuary, I think it's just a random event that there's 4 women up here. And
Thanks for that. Sorry.
Just again about the governance heading in a female-oriented direction. I'm not sure if that's actually, I don't think that's the case. However, it is said that the ability of a leader to feel empathy with others will be the moral compass of an organisation. Oh, that's pretty deep, isn't it? So,
that's right. Write that down.
But if you actually think about it, the ability of people to understand how the decisions they're making are going to affect other people will radically affect the decisions you make in your organisation. And so it's possibly not the fact that it's governance, but maybe it's that ability to feel empathy with other people.
Yeah, thanks for that. Just a question. I thought we talk about best interests of members, and that seems to be something that drives what we do. It's meant to be. It is what does drive what we do. How do you, when you just sitting at home watching TV, or you're actually sitting around the board table making decisions and considering and contemplating issues that are presented to you, how do you think of what best interests of members means, given that you have tens of thousands or hundreds of thousands of members who are each individuals, and trying to get the optimal outcome for them as individuals or as a group? Jay?
Oh, well, just personally, I always remind myself that the stat around HESTA is that our average member, and I think I've got this right, is a 42-year-old woman with 24,000 in her fund, and I think to myself, that's what it's all about. So that's my personal little prompt for me.
Yeah, I suppose in the best interest of the member, for me, is really about what our primary goal is, and that's being able to provide for that member in retirement. And it's not an individual member, it's the group of members. And yeah, so I think that for me that's the driver. How will this decision affect our ability to provide them with an adequate retirement income?
Thanks. Michelle?
And, I think about what would I want oh, sorry, I mean, that might be very selfish, but, you know, I have superannuation too, and I want it to grow, and, you know, I want things from my fund, and I want them to talk to me, and, you know, so sometimes it's just, what would you want? And, you know, from our fund, we've got, you know, lawn care people as well as general managers. So we've got a huge gamut of people who are, you know, quite across a large spectrum. So thinking about all of them can be quite difficult. But, you know, I would actually say you could ask your members sometimes. I don't know how much we engage with our members directly around some of the decisions that we need to make, and that's maybe controversial, but a bit more than a net value, potentially. Net promoter score. That's what I think.
I have a slightly different view about best interests in that I think it gets misused quite a lot, because just about every, like I've sat on boards for many, many years, just about every paper that's ever come up suggesting that more money needs to be spent somewhere comes with that, and it's in members' best interests, you know. And I think it's like a throwaway line that's often used to almost justify every single thing. And, you know, the FS inquiry has raised the issue about feature-rich superannuation which has got lots of bells and whistles and everything for all men. And I think that sometimes, there's nothing wrong with that approach, but I think some people think that to have the opposite approach, which is a much simpler structure, much simpler options, much fewer bells and whistles, somehow is not meeting the members' best interest test. And I think it is potentially meeting the members' best interest test. I think that, you know, I call it the Bunnings model. It's possible to have a product that meets 80% of members' needs 80% of the times, and that still meets the best interest test. And providing something that meets every member's need every day of the week is not necessarily in the collective best interest test. So I think the best interest test, I think it's a great feature of our superannuation environment, but I also think it's the most potentially misunderstood or slightly abused concept to sort of justify anything.
Thanks, Kathy. We have a final question from the back. The microphone's gone. Do you want to shout?
Yeah, Catherine, you mentioned the role of trustee was becoming like quasi-management. I'd like to hear from the panel what they thought that was true too.
If you'd ask the staff of our funds, they would say that that's not a good thing. I think that, as you know, the original question around focus, strategy and compliance, I think that boards need to be, now that, you know, we've got the stuff with APRA all sorted and we're all under control, let's get back to strategy and growing our funds and looking after the best interests of our members and all those sorts of things. And I think that from a strategic perspective, we need to be involved much more in fund decision making, and rather than just getting reports on a monthly basis, we actually need to be setting the future of where we want this to go. And I think that's how we get involved rather than in the day-to-day running, but certainly we need to have much greater focus on strategy.
Thanks. Tracy?
Yeah, I think boards can get too wound up in the day-to-day management, and sometimes a lot of that, it's a good thing that a lot of that compliance work is actually pushed down to committees. But also we have to remember that we have to be able to sign off on all the trustee covenants, and we have to know enough about what's going on a day-to-day basis to be able to sign those covenants. And that's where the importance of robust frameworks at committee levels feeding up to the board is absolutely crucial.
Final word to Jay.
I'd agree with Tracy, and just personally I think Hester does it well. We try to stay strategic at board meetings. We do a lot of our work in committees, and we certainly understand that line between management and board.
Fantastic. Look, thank you very much, everybody, and I want to thank all our panellists, our speaker Kathy, Jay, Tracy and Michelle for a fantastic session, and hopefully fantastic feedback, honest feedback that can be taken back to your own boards and your own organisations